Hello, scholars. Welcome to Bond Valuation for Corporate Finance. And here we're going to start with one of my favorite bond investors that I was lucky enough to meet. This is Howard Marks. And what I loved is one of his books here, The Most Important Thing. The reason I like that book is he really talked about what he believed was the most important thing in investing. And he wrote that book because he saw that he's catching himself a lot and saying, well, the most important thing is this, and the most important thing is this, and the most important thing is this. And the point is, everything's important when it comes down to investing. So he's been a teacher to me. I love his books, his memos, the interviews. So when I had the chance to meet him in Miami, I was very, very excited to thank him for everything he taught me. And, anyone in finance, even though I'm a finance professor, we still have something to learn. So he's one that I hope you consider reading memos and learning from. So let's take a look here at the outline of what we're going to do. We're going to talk about bonds today, and I have a great Wall Street Journal article I think you'll enjoy. We're going to talk about key terms, get you an idea of some of the features of bonds, and give you an appreciation for the vast variety we have of different features and types of bonds. Then my favorite piece is valuation. If you know me, I love valuing financial assets. Timing, risk, and magnitude, again, when we get to valuation. Talk a little bit about bond pricing terms and the relationships with bonds. Then dive into credit risk, credit ratings, credit analysis. Talk about the Fisher effect, bond yields, and of course, examples as we go. And here's a nice little quote from CFA Institute when I was studying for, I believe this one was like level 3. Judged by total market value, fixed income securities constitute the most prevalent means of raising capital globally. And if you're just getting into finance, perhaps you didn't appreciate that because we hear a lot about stocks and the stock market. But really, when you consider it, fixed incomes play a huge role in terms of financing. And why do we care about financing? Well, early on in some of the lectures, we've seen assets and liabilities and owner's equity, right? So this is perhaps what you call your balance sheet identity. Some of you call it the accounting equation, but we're talking about corporations here raising debt, liabilities. So this is bonds. Bonds would be here. So we're talking about sourcing capital, and this is the use of capital over here, the asset side, and this is the source. So the most prevalent means of raising capital is right here, bonds. So that's why this is so important for us, even though we hear a lot about stocks and stock market, but we really have to understand this one because it is the most prevalent means of raising capital. Remember, capital we consider the use of long-term assets. When we have those ideas, those capital budgeting ideas, if you're in marketing or whatever, if you have an idea that lasts several years, we're going to have to finance that somehow. So you can keep having those great ideas and we'll help you implement those here. So let's understand some fixed income. Look at this article, a bond that's still paying interest 250 years later. So it's the world's oldest government debt. It doesn't yield very much, but still pretty cool effect here. The yield only buys enough to buy a baguette of bread once a year, but still pretty neat. These fixed income securities, we consider them fixed because the payment schedule is fixed, it's predetermined. In this case, it's a fixed amount a year of what this bond will pay you back. So we have 100-year bonds still. I'm going to scroll down. I'm going to give you the link to this article in case you're interested in the whole thing. And I wanted to show you this picture. Take a look at this bond. This bond is still paying interest, and it was printed on goat skin. So in 2003, Yale University acquired the world's oldest debt still being honored. It's the 1648 Corporate Dutch Water Authority bond written on goat skin. That is pretty neat. So the full article, I have a link down here if that's something that interests you. Please take a look. So if you're into any of this kind of thing. All right, bonds. What is bonds? What are debt? Debt is borrowing money. We often hear this called liabilities. The use of debt in capital structure is called leverage. So sometimes they'll see this as well. So maybe those L's, liability, leverage, loan. Maybe that'll help you think of all those are debt instruments. So leverage is the process of using debt. Using debt. So if you have to raise capital, the most prevalent means of raising capital is debt. We call that leverage. I think in the UK, I've heard that this is called gearing. So all these are pretty synonymous. If you hear liabilities, that's debt, that's borrowing. Think of a loan, liability, leverage. So what is it? Fixed income. Fixed income is debt. Again, that's another synonymous word. It's contractually included predetermined payment schedules, hence the fixed portion that usually include interest and principal. So principal is the amount you're originally borrowing, and then interest is kind of that cost of borrowing. So a bond is just what it sounds like. It's a contractual agreement between an issuer and the bondholder. So in our case, if we're in a corporate finance class, this is a corporation. I mean, it could be a municipality, it could be a government, but in our case, we're trying to think in corporate finance. A bond certificate gives you the terms of the bond as well as any of the amounts and dates of all the payments to be made. Again, everything is predetermined or fixed. This would include notes, bonds, and ABS, asset-backed securities, or even mortgage-backed securities. So let's go do some terms here. These are timing terms. Maturity, that's when the final repayment date of the bond will be. Term or tenor is the time until the maturity date. And now cash flow terms. These are very, very much worth studying because any kind of quantitative examples you get with fixed incomes will use these in the problem. A face value, par value, principal amount, that's the notional amount of a bond. And that's the amount that will determine the amount of the interest payment. It's the face value of the bond is generally due at the bond's maturity. So it'll repay at the maturity point. It's also called nominal, redemption value, maturity value, or just simply par or face. I mostly use par and face value. Coupons are the promised interest payments of a bond. Most of the time you see these paid semi-annually, but the frequency would be specified. In my class, I just use semi-annual bonds 90% of the time, and sometimes I give you an annual bond. What is a coupon? Well, the coupon is that interest payment. So to get to the amount of the coupon payment, you need the face value of the bond, which we just defined above, times the coupon rate. That's your numerator. So that would be the annual amount of the coupon divided by the number of coupon payments in a year. So that numerator on this is the annual amount. So the coupon rate times the face value divided by the payments in a year. So if it's semi-annual, you'd be dividing by 2. And we'll do plenty of examples of that. Don't you worry. Rates with bonds, don't get too confused here. Again, I think this would be a great tool to study for flashcards. So coupon rate, yield to maturity, current yield, don't get these mixed up. The coupon rate determines the amount of the coupon payment of the bond. The coupon rate expressed as an APR is set by an issuer and stated on the bond certificate. The coupon rate is the annual coupon as a percentage of face value. But remember, you may have to make an adjustment if it's a semi-annual bond, in which case that numerator or that denominator, sorry, would be 2 if it's semi-annual. It would be 1 for an annual bond. So the coupon rate, the only reason we really use this is to determine the amount of the annuity stream on the coupon payment. The yield to maturity, perhaps the most important interest rate when we talk about bond valuation, or we just call it the yield, is the rate of return of an investment in a bond that is held to the maturity date. It's also, and this is the way I think of it, it's the discount rate that sets the present value of the promised bond payments equal to the current market value of the price. So think of this, if you're looking at investing in a bond, you observe the price and all the cash flows are predetermined and fixed on this according schedule. So if you can observe the future cash flows, their timing and magnitude, and you can observe the price, the one piece that you're inferring there would be the yield to maturity. So the yield to maturity is that discount rate that sets the price of the bond equal to the present value of the future cash flows in expectation. And that's an important piece. So the yield, think of the yield is the rate required in the market on a bond. And when you think about this, stock market investors are always talking about a stock's intrinsic value, fundamental value, its worth today versus its price. With bond investing, we talk about yield a lot. Is that yield enough for the investor or not? For riskier bonds, typically investors require a higher yield. So the current yield is the annual coupon amount divided by its price. Don't mix these two together. The yield to maturity is the discount rate. So we're going to use the yield to maturity when we do bond valuation. And the current yield is just the annual coupon amount divided by the price. So we'll get to pricing terms a little bit later, but there's three pricing terms we talk about. It's the discount, the par, and the premium. We'll get to that later. This is just a sample. This whole page, page 4, is just going to give you a flavor for all the different types of future features there are with bonds. There's government, U.S. Treasury, government bonds, or state bonds, municipalities, agencies, corporations, foreign governments. Terms differ as well. So that length of time, there can be short term, long term. I gave you a couple of examples in there, even all the way up to perpetual bonds. Those consols are perpetual bonds. We'll talk about pricing terms again. Like I said, there can be discount bonds, which sell for less than their face value, par bonds, which will sell for their face value, and then premium bonds, which sell for more than their face value. We'll dive into coupons. So when you think of that, maybe that's the annuity stream, but it doesn't even have to be a fixed amount. Some of these can be variable, and some of those are floaters or inverse floaters, so you can link them to interest rates. So if interest rates go up, maybe your bond payments also go up. So we have Yankee bonds, Euro bonds, samurai bonds. Most important definition here on this page might be credit risk. And credit risk is the risk of default by the issuer of any bond that is not default free. So make sure you study credit risk. And there's a whole section where we'll talk about this risk of default. So if the bond defaults or has a risk of default, we say there is credit risk. Not all bonds are created equal. There is seniority, which means they have a higher stream. They have a higher claim on the stream of cash flows by a company. So senior secured, that means they have more priority versus, say, a junior bond. Secured means there's some type of collateral. Either it's a physical asset, maybe a piece of equipment, or just a general obligation to get a claim on the revenues of something. So secured means there's something securing it. There's a little bit more certainty versus an unsecured bond that may not have an asset tied to it or may not have a revenue stream tied to it. So again, the security usually refers to collateral, but it could be an income stream. So here in the New York State interstate, when they built this, they said, we're going to raise money. So maybe they issue bonds to raise money to build this interstate. And then the promised stream of cash flows that could go back would be the income from tolls. So sinking fund provisions, we'll get into maybe a little bit later. I love these two, the options provisions. Now in this finance course, we're not going to do a lot of valuation of these options provisions, but they're still nice to look at. We'd get into this more in a fixed income course. Callability. So with a bond with a call feature says that after a certain period, the issuer has the right to buy back the bond, to buy the loan before maturity. So we'll talk about this a little later in terms of whether that adds to the yield or not, but typically whoever has the option has more value. So in this case, the issuer, so think of the corporation in our example, if they have the right to call the bond back, that's not great for the bondholder. And when a corporation calls the bond back, it's when the bondholder doesn't want them to. So if interest rates fall, for example, maybe the value of the bond has gone up. There's an inverse relationship between interest rates and valuation. So for declining rates, maybe this company has a security where they have a 10% promised stream of coupon payments, and now interest rates have fallen. So the company may want to call the bond back right when it's valuable to the bondholder and then issue more debt at a lower interest rate. So callability, that typically is not desirable for the bondholder, so those typically have higher yields. Putability, now that's the opposite. So the bondholder now has the right to demand payment of the loan before maturity, and that is favorable to the bondholder. But since that's favorable That's going to cost a little bit more to have features like that in the bond. Convertibility, these are super fun. So doing the valuation on these is also interesting because you have a piece of it that deals with debt and a piece that deals with equity. With a convertible bond, the bondholder has a right, not the obligation, they have the right to exchange the bond for stock of the issuer. So again, we'll dive into those more when we do a fixed income course, but it's just nice to give you a flavor of all the different types of features that there could be with bonds. Typically, when we talk about stocks, we think of, oh, Tesla, and Tesla may have just one class of stock, for example, but there's so many different varieties of bonds out there. Let's talk about some of these features. Let's continue with an indenture. An indenture is a written agreement between the corporation and the lender that details the terms of the debt issuance. It'll have all the terms of the bonds, the amount of the bonds that were issued, how many were issued, and for how much, if there's any collateral or anything secured, any repayment arrangements, if there's call provisions, put provisions, and any protective covenant. So think of this as a contract, right? We call it a bond, and everything about this bond we're going to specify in the indenture. So what are these covenants? Well, there's two types of covenants. A protective covenant is the part within the indenture limiting the actions that might be taken during the term of the loan, usually protecting the lender's interest. So that bondholder's interest, this is what will protect them. And just like if you think of Indiana Jones and the Ark of the Covenant, and there's negative covenants and there's positive covenants, and the reason we say these thou shalt not, these are negative. So if these are going to protect the lender's interest, the negative covenants are things that limit what the issuer can do. So maybe limit dividends, can't pledge the asset more than once, can't merge with another firm, and anything like that. So positive covenants, on the other hand, those are thou shalt. Those are things that the company must do in order to protect the lender's interest, like maintain the working capital if that's perhaps the collateral secured. They must periodically furnish audited financial statements, and they must maintain the collateral, like I mentioned. Please don't get indenture and debenture confused. An indenture is the written agreement. A debenture is unsecured debt. So often, students will get these two, but a debenture is unsecured debt, and indenture is the written agreement. Take a look at this. This is a pretty neat picture. If you're into scripophily or collecting any stock or bond certificates, that's the phrase given to that hobby, scripophily. Why do we call some bonds coupon bonds? Well, back in the day, we used to actually cut these coupons off, present them, and then get the payment for the coupon. So coupons, perhaps you don't even see those in newspapers anymore, but these little strips would be cut out and turned in exchange for the coupon payment on the bond. Hard to find those intact. She said, "What's your type?" I said, "I like what I like." And when I hear that song, I always think of types of bonds, different types of bonds. Let's take a look for ourselves here. Coupon bonds and zero coupon bonds. Coupon bonds pay regular coupon interest payments up to maturity, and then they repay face value at that time. Zero coupon bonds, they don't make any coupon payments, hence the zero term there. They just repay at maturity. Then I'm going to put these three together: treasury bills, notes, and bonds. So bills are zero, coupons, maturity of up to a year, treasury notes, those are traded with maturities of 1 to 10 years, and then treasury bonds. Those will be traded also in financial markets with maturities of more than 10 years. So if you have a professor that likes multiple choice questions, take a look and make sure you know the difference between bills, notes, and bonds. So things, with bills, there's zero coupon. The other piece is they're up to 1 year. With notes, that's 1 to 10. And then with bonds, that's more than 10. So make sure you study the difference of there. Corporate bonds, those are issued by corporations, and these are pretty fun. Look at these pictures here. Maybe if you're any movie buff, you'll recognize these. Any great movie in the 80s was about finance. And the first one here, these are bearer bonds. Bearer bonds in this picture is a form of a bond issue in which the bond is issued without record of the owner's name. So whoever holds the bond, whoever's bearing that bond, the payment will go to them. So this is from the Great Finance movie. It's not a Christmas movie. It is a Christmas movie, but it's also a finance movie. Die Hard, the finance movie Die Hard. We wouldn't have that movie if it weren't for bearer bonds. That's what they were doing in the building. So there's your bearer bonds. So you're welcome for that. You wouldn't have that without finance. And then this is Nick Leeson, true story. If you watch this movie, Nick Leeson, this is in Rogue Trader. He's out of jail now. But I believe he's a motivational speaker. But early in his career, he was working through some bearer bonds. Interesting scenes there. Registered foreign bonds, on the other hand, this is where a registrar of the company records the ownership of the bond. So unlike a bearer foreign bond, the company knows who owns the bond. And I have to update these numbers here, but the largest securities market in the world in terms of trading volume is the US Treasury market. I don't know if you're going to consider also currencies in there too, but that's also a massive market. So let's look here. This is my favorite part of the lecture when we talk about valuation. And again, when we talk about valuation, to me, in my mind, I think of timing of cash flows. When will I get my cash flows back? Two, the risk of those cash flows. And third is the magnitude. So timing of cash flows. For us, we're thinking of when we get those coupon payments. Maybe it's semi-annually. And then at maturity, we'll get the face value back. Risk here, in my mind, we're talking about the yield to maturity. In the magnitude, it'd be the amount of the coupon payment and the face value, the future value, the lump sum at the back. So let's take a look at what Mr. Buffett has taught us and what he said. There are only two variables to value any financial asset. That's the stream of cash in and out between now and Judgment Day, discounted at the proper rate of interest. So how do we apply that for bond valuation? Well, here we go. So any financial asset here, the financial asset we're talking about are bonds. The stream of cash in, if you're the bondholder, the stream of cash in is the coupon amount and the face value. That coupon amount is typically an annuity, fixed and finite cash flow. So it's a fixed amount pre-specified with the coupon rate, right? So if here's time on top, what period we're talking about, maybe semi-annual periods up to T, you have an annuity most of the time. And it's a semi-annual annuity. So every 6 months you'll get a payment and then face value. So that's the cash flow you're expecting, an annuity, plus a single cash flow at the end, the face value or par value. The price, that's your present value. Well, we'll loosely call it present value. Out between now and Judgment Day. What's Judgment Day in this case? Well, that's when the maturity occurs. Discounted at the proper rate of interest. So we're going to value these at the yield to maturity. So one way to try to maybe back into this, bond investors, typically we observe the present value and we can observe the expected cash flows, the coupon stream and the face value. And so then we're focused mostly on the yield to maturity, as opposed to a stock investor that's typically very, very focused on the present value. So similar equation with valuation, but a different focus. For bonds, it's all about the yield. For stock investors, it's all about intrinsic value. And I'll actually reconcile those two with another Buffett quote at the very end of the lecture, so you have something to look forward to. Here's a couple ways you could think of what a bond should be selling for. So I'm going to use this term loosely here, price. We'll talk about price versus value again at the end, but a bond should be selling for the present value of the coupon stream plus the present value of the face value. So your coupon stream is that annuity perhaps, and this is your equation for an annuity, and then face value is out here, plus the present value of face value, and that's a single cash flow. So a couple ways you could see it. The one I really like to view this on is actually the middle one when I think about bond valuations. And the reason I like that is we could think of this as a series of individual cash flows. But if you think of it this way, you're just discounting many cash flows as single cash flows. And the reason I like thinking of that is maybe these yield to maturities differ by year. maybe you're thinking that the cash flows that occur later out here, these cash flows perhaps are riskier and maybe should have a higher yield to maturity than the ones that are sooner. But again, you'd get into the mathematics of that in an upper level fixed income course. But for us, I want you to think of a bond's value as being determined by two pieces: an annuity of your coupon payments and a single cash flow, the lump sum of par value. And I'll show you that. I'll show you with this example. Consider a bond with a coupon rate of 10% annually paid. So it's an annual 10% coupon and par value is 1,000. So your coupon payment is your coupon rate times your face value over the periods in a year. I'll just be careful here with the brackets. Your coupon rate in this case is 10% times face value of 1,000. And if it's an annual bond, there's only one period in a year. Had that been a semi-annual bond, you would divide by 2. But in this case, we're just going to divide by 1. So this is a coupon payment of $100. So that's where this 100 came from. And that's where this 100 also is. It's not showing in the denominator here just because it's divided by 1, but just be careful. Yield to maturity, that's your discount rate and bond valuation. So this piece, this 11%, is what you're going to see referred to as R or YTM. That's where the 11% is coming in. And then timing. In this case, this bond has 5 years. It's an annual bond, so we're going to consider it as years. So that's where the single cash flow gets discounted 5 times, and we have 5 payment streams there. So 2 ways you could get to this. The first is formulaically with an equation. With bond valuation, I do prefer the financial calculator or Excel, just because we're typically solving for the yield, which is an internal rate of return calculation. So it's a little bit faster with the financial calculator. So N of 5, yield to maturity, YTM, that's your discount rate with bond valuation. That's the rate that the market wants to earn on this bond. So one way to interpret this question after you've identified the variables is to say, hey, this company is offering you a bond which will pay you 10% annually. The market wants to earn 11. That's the rate required in the market. The market wants to earn more than you're offering. That bond's going to sell for less. That's going to be a discount bond. So where's that extra 1% going to come from? Well, the bond will be pulled up in value over time. As you hold this bond, you're expecting it to rise in value, and that's called a capital gain yield. So you're going to pay a lower price for this with the expectation that the bond value will increase over time, and then your total return should be expected to return 11. So the company's offering 10, you want 11 as a market participant. You're not going to pay full price for this bond. It's not offering you enough. If you pay a lower price and the yield doesn't change, you're going to actually end up earning 11% because that bond will be pulled up to its face value. Think of it as time goes on. This cash flow, this future cash flow will get closer and closer. That denominator's exponent will get smaller and smaller and smaller, and then the whole denominator will converge to 1, and this piece will become more and more a component of the price as present value. And I'll show you that when we get to the pull to par section. So here we go. Let's take a look at some of these bond pricing terms and see if we can understand why we have these terms. So let's look at this bond, the yield to maturity. What is the yield to maturity on a 3-year annual pay coupon bond selling at par with a coupon rate of 8 and a face value of 1,000? Here's your bond price. I'm just going to put this formula in here. And I'm just going to set it up for you. The bond price is 1,080 coupon payment, and this is why we call this an internal rate of return calculation, because the piece we don't have is the yield to maturity. If you're looking at this formula and say, how'd you get R? Well, here's where I like to use the financial calculator. Your present value is 1,000. We'll put negative to think of you have to pay that price in your financial calculator with the expectation of receiving a face value of 1,000. Your coupon payment is your 8%, spot 0.8 times 1,000 divided by 1. just because it's an annual bond. Again, if it was semi-annual, you divide by 2, so that would be $80 there every year. And an IY, which we're looking for, so that's what we're going to compute, and an N time of 3 years. So timing, risk, magnitude, all those are consistent. That's year, that's a yield per year, and that's years. So we're all set. Let's see what we get. Some of you may say, well, why are you even going to bother calculating that? Well, I'll show you in just a second. So 1,000, whoops, got a little greedy there. Let's trim that back a little. 1,000 outflow, present value. You have to pay that price with the expectation of receiving a positive future value and a positive income stream payment. Make sure face value and payment have the same sign. In this case, I like to keep those positive and then the price negative. I love thinking as an investor, what do I pay today with the expectation of receiving in the future? So I expect a positive 80 and a positive 1,000 for 3 N periods. And then I'm going to compute for my IY. And we get 8, and that's not coincidence. We get 8% right there. So 8%. In this case, the company or the issuer is offering 8%, and it's selling at full par value, which means it's selling at its face value at 1,000. So it's offering exactly what it would. This would be a bond selling at par. But if the bond actually sells at 900, let's say the price here is now negative 900 and no other variables change. So this is 900 price, negative PV there, and then compute for the IY. This is higher. The yield is about 12, oops, I missed it, 12, 18%. So in this case, all these numbers are still the same, right? The coupon, this fixed amount hasn't changed. It's just now the market is demanding a higher yield for this. This bond is riskier. So the company's offering an 8% return, but the bondholder, the market participant, wants to earn more. That's going to come through paying a lower price on this bond. This is a riskier bond. It's not getting enough in terms of coupon payment, so the yield has to be higher. So how does this work? Well, let's take a look at this discount bond. The coupon in all of these cases, one we've just looked at, the price is 900, coupon rate is 8. The current yield, that's your annual coupon of 80 divided by the price, is 888, and the yield is higher. So the market wants 8, the market wants 12, company's paying 8. So where's the rest going to come from? It's going to come from the fact that as time goes on, the bondholder's price is expected to converge to 1,000. So again, that denominator exponent is going to get smaller and smaller over time, meaning the price is expected to converge upward. You're going to pocket annually 8% from the coupon, and then the rest of your return is going to be made up on the fact that this 900 is expected to increase towards 1,000 over time. So again, there's 2 ways to make money in finance, right? If you hold a financial asset, it pays you cash flow while you own it, a dividend for a stock or a coupon for a bond, and then it goes up in value. So this bond is expected to increase in value over time. So its price will start at 900 and it'll converge up to 1,000 in expectation. If the bond sells at 1,000, the yield is just going to be 8%. So at par, the price is 1,000 and the coupon is 8 still. It's equal to the current yield, which is equal to the yield to maturity. Now, if the bond sells at 110, minus 110 there, or 1,100, I mean, sorry. In this case, the yield is going to fall. So the market participant here is okay earning 4%. Maybe they see this as a very, very safe bond. They don't require much return on it. And the company's offering a lot of coupon payment there. So that's a premium bond. This bond is paying 8. You're okay earning 4 as a market participant bondholder. This bond is going to lose value over time. You're going to pay 1,100 and it's going to lose money every year in expectation until it drops down to 1,000. So that's where we get these pricing terms. Discount bonds. A discount bond is a price at which bonds trade that is less than the face value, and that occurs if the yield exceeds the coupon. So think of this as the market wants to earn more than the company's offering. So they're going to pay less in order to get that return. So if the market wants to earn 12% in our case, and you're only offering 8, that's a discount bond. The market needs more return, so they're going to pay a low price. The low price is expected to converge upwards to a high price to make up for that. So in the case of a par value bond, everything's set that the yield equals the coupon rate. So that'll sell at par, and a par bond is when the price of the coupon bond trades at its face or par value. Face is par, remember that. Premium bonds, a price at which coupon bonds trade that's greater than face. So the yield to maturity is less than the coupon rate. When that occurs, then the bond price is more than par value. Finance professors love testing you on the first and the last one, just so you know. So the yield to maturity in this case, the market participants are okay earning 4%. In this case, the bond coupon rate was 8%. So that's a premium bond that's going to sell for more than face value. This bond is expected to lose money over time. So the total return may end up actually being 4% despite paying 8, because you're paying 1,100 for a bond that will eventually pay back just 1,000. So that is going to lose money over time in terms of capital gain or capital loss. So make sure when you're studying these, you try to think through them too, not just memorize these, but discount bonds occur when the yield exceeds the coupon rate. That means the bond price is less than par. With a premium, the yield is less than the coupon rate and the bond price is more than par value. And if you think about these as a timeline, that can be helpful too. Again, just go back. We do a lot of financial calculator here, but don't lose track. It's not magic. It's just math that thing's doing. This is time 1 through 2, all the way through n periods and semi-annual periods. Maybe you're getting a payment. This piece is not changing. That's the fixed income portion, right? We're already specifying what those cash flows are. Maybe they're 50 per period. And this face value is 1,000. So we know maybe time is 10. The piece that market participants will come up with is an appropriate yield to maturity. That's the discount rate on the bond. So that's up to market participants. And then that is the present value of the bond. So we're using the price as an estimate of its value, but think of this present value as being observable in financial markets, and the annuity stream and the face value as being fixed or pre-specified in the indenture or in the terms of the bond. And what's changing for financial markets is the yield. So if the yield is increasing, that discount rate gets higher and higher and higher, the present value of the bond will decrease. So I'll put it here on a little teeter-totter for you. The bond value increases at low yield to maturity, but the opposite is also true on this teeter-totter. So if the yield to maturity increases, the bond value will decrease. So maybe you could think of at riskier times, the bond will sell for less, it'll have lower value. So in our case, if the yield to maturity is increasing, the bond value will decrease. So these cash flows in the middle aren't changing. It's just the discount rate that's changing. Maybe you think of stocks as their price changing all the time. Well, with bonds, think of the yield to maturity as what's changing, because that's the piece that's market determined. The bondholders are always changing the yield, and if the yield is changing, then the price is changing. So again, the focus is on the yield in this equation. So at high yields, the price will decrease, maybe eventually to the point where it's a discount bond. And these cash flows, these expected future fixed cash flows, aren't changing. So if you pay a low price, then discount bond, that eventually will converge up to a present value of 1,000. So you'll get maybe some expected cash flow increasing. Let's take a look at 3 important pricing relationships. If you're a visual learner, this might help you quite a bit. The first important relationship is that there is a negative and convex relationship between yield and price. So at higher yields, the bond price will decrease. That's what I was drawing here in purple right above. At higher yields, the yield to maturity increases, the bond's value will fall. There's an inverse relationship there. That's or a negative inverse relationship. Make sure you know that. And I put it here. I don't exclaim much. If you watch my Instagram, you'll know that's true. As the yield to maturity increases, the bond price decreases. So if I'm not exclaiming in my Instagram and I'm exclaiming here, this is important to know. Inverse negative relationship between yield and bond price. Interesting piece I left out here. Let's see if we can think through what that piece was. This bond that I graphed is just showing its value or its price at different yield to maturities. And we see that negative relationship there through the slope. The convexity gives it that bendiness, if you will. See, it has a little bit of flex to it. That's convexity, which you'll learn about more in a fixed income course. This is an annual coupon bond. Its par value is 1,000. Its maturity is 10 years. So what is the coupon rate? Now, when I teach class sizes of 250, typically I have to ask a few students, and typically 1 in 250 students will know how to solve this question. And the answer is if the par value or face value is 1,000, you can infer from this graph the coupon rate because you know when the bond's price is 1,000, it sells at par only when the coupon rate matches the yield. So 9%. Now, if you didn't pick that up, that's okay. It's the first time we're seeing these. It just means maybe do a little bit of practice, but that's actually very uncommon for students to pick that up. So don't feel bad yet. But let's take a look at those other pricing terms, see if we can make sense of them here. In this case, if we know the coupon rate is now 9%, this bond sells at par value. If the yield to maturity falls, the bond price increases. Everywhere here, this is a premium bond. The price exceeds par value. And that occurs because the coupon rate is greater than the yield to maturity, right? The coupon rate is fixed. That's the 9%. And if the yield is less than that, it sells at a premium, right? Because the face is 1,000. Now, let's take a look at a discount. If the market participants now want more required return than is being specified through the payment of 9, this is a discount bond. So everywhere here is a discount bond. And a discount bond is occurring because the yield to maturity exceeds the coupon rate. Market participants want to earn more return than is being paid through that cash flow by period. So they're going to pay less for that bond with the expectation that that lower price will eventually converge upward or increase in value towards par value over time. So part of their return is going to come from a capital gain is what they expect. So I hope that visual helped you put some of that together so you're not just memorizing definitions and terms, but maybe just remember, we've seen this negative relationship a lot. This is not so unique to just bonds. We see this when we look at capital budgeting. We see this when we look at stock valuation or firm valuation, that there's this negative relationship between discount rates and valuation. So just remember, if you can't remember whether this goes up or downward, there's an inverse relationship, and we see that quite a bit in finance. Let's look at now overlaying, in addition to that red line, that coupon bond we saw in the first example, I changed the maturity in this bond. So instead of just looking at a 10-year bond, we're looking at a 30-year bond as well. And what do you see? Bonds with longer maturities, that 30-year, is more sensitive to a change in rate. Now, Chauncey, how do you figure that out? Well, let's just start at one point and see if we can figure that out. Both these bonds have a coupon rate of 9, so let's just see right there, if the yield to maturity is 9, both bonds would be selling at their par value. That checks out, right? The yield to maturity and the coupon rate equal. The bond will sell at par. Fine. Now, if the yield is less than the coupon rate, both bonds are premium. Okay, that makes sense. If the yield is higher than the coupon rate, then both bonds will sell at a discount. Okay, but take a look here. If the yield falls, if we move in this direction very dramatically, if they started at the same price here at 1,000, and the yield falls, which bond loses more or gains more? In this case, the blue bond gains a lot more in value than the red bond. And which bond increases more? Which bond decreases more as yield increases? Well, the blue bond, again, and that's what I'm talking about with sensitivity. So if you, let's say we drop 300 basis points or 3%, blue bond increases faster as yield falls. Blue bond also decreases faster as yields increases. So there's more change. That's why I'm saying there's more sensitivity for the blue bond. This is where we'll get into convexity too in a fixed income course, but let's just again recap. If we're think of starting at par value and then a 300 basis point decrease, which bond is impacted more? The 30-year. Everything else about these bonds I set equal to each other just so that we could isolate the effect of maturity. So the only change here is if we're going from 1,000, this red bond is here, blue bond is higher. So as yield falls, blue bond increases in value faster. As yield increases, blue bond decreases in value. That has much lower value than the red bond out there. If you're struggling with these, try to write these down. Try to see if you can figure this out for yourself. Last one I want to give you is that bonds with lower coupons are more sensitive to changes in rates. This one's a little bit harder to see from the graph, but all I changed was a purple bond that has 0 coupon and then a red bond that has a 9% coupon. This one's a little bit harder to see in a graph, so what I'm going to do is rely on the formula to help me explain this one. Let's look at this. If you have two bonds that are both being determined by these two components, the first one is the annuity of the coupon payments. I'm going to just call it the PMT portion of that value in your financial calculator. This piece is a single cash flow. That's the face or par value. Imagine a bond that has a high coupon payment. Let's say it's 20% if we're having fun. Then a lot of the valuation of this bond is going to be made up here. And then less of it will be made up of the future value compared to a bond that has 0 payment. A 0 would have no annuity payment, hence 0. All of its bond value, its price, is determined by this second variable. So let's zoom in on that second variable. All of its value is determined here. The face value on top, time, and then rate. So let's again go back to this relationship that I'm trying to illustrate. Bonds with low coupons are more sensitive to a change in rate. So if there is a rate change, all of it will be impacted exponentially by the full time to maturity remaining. So any tiny change will impact right there at R. It's going to be magnified by a huge time there. Whereas some of these annuity payments are going to occur early, and then later less so. So these, if there's an interest rate change, some of it's only going to be discounted once or twice or 3 times as opposed to perhaps 30 or 40 magnification on the exponent. If that helps you, fine. If not, that's understandable as well. Again, we're going pretty quickly through this, and we have a whole 15-week course on fixed income security. I'm just trying to help you build a little bit of intuition. Bond pricing and reporting, how do we see this? So bond prices are typically quoted as a percentage of face. So you may see in a bond question, a bond is selling for 105. That just means if you see 105, it means it's selling for 105% of its face value or of its par value. Face/par value. If the question gives you par value as opposed to face, a common mistake I see students make is they consider that PV, but par value is future value. That's the cash flow you get at the end. So again, on your financial calculator, just so you know what that's doing, if this is time 0, and this is the next period, and this is time to maturity of N, your coupon payment is here. That's the annuity, the fixed and finite portion. The face value is a cash flow out there. Like I said earlier, I like to keep these positive. the same sign because that's the cash flow the bondholder is expected to receive, and then the price negative. So if you ever get error 5 in a bond valuation question, set the price negative and keep the coupon payment and face value positive. And then these are set equal to each other or discounted at the yield to maturity, which on your financial calculator is the I over Y over N periods. And again, the piece here is if the bond is semi-annual, then N is semi-annual periods. The coupon payment is a payment per semi-annual period, and the yield to maturity is a yield to maturity per 6-month period. So we'll have some definitions here of a bid and ask, a bid-ask spread. So that'll then get us into clean and dirty prices. So a bid price is the price the dealer is willing to buy a security for. So you always get the one you don't want to do as market participant. So if you're buying a bond as a bondholder, you're looking at a bond, well, you have to buy at the ask price because that's the price the dealer will sell it to you for. So again, that ask price is going to be higher than the bid. And if you want to buy it, you're going to pay the ask and you'd sell at the bid. So it's always the one that's to your disadvantage. Remember, if you're buying, you want to buy at a low price. But this one's at your disadvantage. That's the one you have to pick up. Why is it different? Well, that's the dealer's profit. That's the spread. The dealer, that's the difference between the bid price and the ask price. That spread is their profit. So if there's a difference, there's a higher spread. The spread is just bid less ask. The ask price is the price they're willing to sell your security. So the investor pays the ask and they sell at the bid. So again, that gets confused for students quite a bit. Just think of it from the dealer. The dealer is the person that you're buying and selling from, the bond dealer. So the bid, maybe the way to remember it, B, buyers buy at the bid and sell at the ask. So maybe that's one way to remember that. And then the difference is the spread. Clean price, that's the price net of accrued interest. That's the price that's quoted. So quoted price is the clean price. That's not the price that ends up being paid. You actually end up paying an invoice or a dirty price. The dirty price is the clean price or quoted price plus any accrued interest. So let's take a look at it. This visualization may help you see the difference between a clean and a dirty price for a bond. Let's say this bond on a timeline, again, timing, risk, and magnitude, is going to pay a semi-annual. If this is today times 0, the next coupon payment is at month 6. You're going to get that C coupon payment, and then again in 12 months for C coupon payment. Now, if you hold this bond for 4 periods, now you're going to have 2 periods remaining until the next coupon payment. So if you held this bond, if you own this bond for those 4 periods, then really 4 out of 6 of this coupon payment belong to you. You held onto that bond. You should be expected to get that reward for bearing that bond for so long. So 4/6 of it are the accrued interest that's due to you. So accrued interest is the coupon payment for the period times the fraction of the period that has passed since the last coupon. Now, the quote price will not include this effect of the accrued interest, right? That's what it means when it says the clean price is the price net of accrued interest. The dirty price is what you actually pay, the full or invoice price. So in this example, remember, you're 2 months away from the coupon payment. You're computing the present value here. You're 2 months from that 6-month payment. So to find the amount of the accrued interest, then you have to take the amount of the next coupon payment times the fraction of the period that you held on to it. And then you use this equation as well to get to the dirty price. It's the clean price or quoted price plus the accrued interest, which we can use this equation for. Let's take a look at an example here. You purchase a bond with a coupon rate of 9.1%, clean price of $11.30. If the next semi-annual coupon payment is due in 2 months, what would the invoice price have been? The invoice or dirty price is, I'm going to highlight this for you, the clean with accrued interest. So we have to find the accrued interest. And if it's not specified, then just know that the bond's face value is 1,000. If a question never specifies it, it's just assumed that it'll be 1,000. So your accrued interest portion here, let's just zoom in, is this equation. It's the coupon payment times the fraction of the period. So in this case, the coupon payment of 9/1, clean price of 11. Next coupon payment is in 2 months. That means there's 4 out of 6 that has already happened. So you take the 1,000 face times the 9.1%, since you're doing formula on a percentage. You have to convert this to decimal form. That's 9.1%. Times 4/6, your accrued interest is 30.33. So your dirty price, or the invoice price, is the clean price of 11.30 plus that accrued interest. So it's the 11.30 plus the 33. So the full price you pay is 11.60. You're quoted 11.30. The difference is the fact that whoever held that bond is due that interest. They were bearing the risk of that bond, so the reward should really go to them. So you're quoted one price, you pay a different price. Now, in terms of pricing, we're going to pick this up next time. Thank you so much, and we're going to do a lot more examples next time we're here. Thank you.